Good morning, traders. This is Evelyn from Astra Montis, and I'm here to bring you the latest insights for the week of November 11 to November 15, 2024. Let's dive into what to expect in the upcoming week. This week unfolds amid significant political and economic developments that are shaping the global landscape, with Donald Trump's victory sparking a rally across markets, including Wall Street, Bitcoin, and the US dollar. Expectations for Federal Reserve rate cuts have dwindled. Meanwhile, the UK's fiscal policy under the new Labour government is putting pressure on the pound, with key data releases due later this week. Across the Eurozone, the euro faces challenges amidst political instability and mixed economic signals. In Japan, the yen continues to suffer, although better-than-expected GDP data could offer temporary relief. Investors are bracing for a busy week of economic data, which could provide further clarity on central bank policies and market direction. Donald Trump's return to the White House has sparked euphoria in markets, with Wall Street and Bitcoin hitting record highs and the US dollar reaching 4-month peaks. Treasury yields surged, reflecting diminishing expectations for Federal Reserve rate cuts over the next few years. Trump's pledges of lower taxes and higher tariffs are anticipated to boost domestic demand and raise import costs, potentially pushing up prices. As a result, the Fed may have to maintain a more restrictive monetary policy for longer. The October CPI report, due on Wednesday, will test rate cut bets post-election, with headline CPI expected to edge up to 2.5%, Y/Y from 2.4%, and core CPI forecast to rise to 3.4%, Y/Y from 3.3%. The 10-year yield on UK government gilts has surged by over 20 basis points since the new Labour government unveiled its tax and spend budget on October 30. Despite £40 billion in tax hikes, increased spending is expected to drive up government borrowing, potentially boosting GDP growth in the current and next fiscal years. The Bank of England has factored the budget into its economic projections, maintaining a cautious approach to easing due to persistent wage growth concerns. Key data releases this week include average weekly earnings and employment change on Tuesday, followed by Q3 GDP estimates on Friday, with the economy expected to have grown by 0.2% quarter-on-quarter. The euro has been under strain due to a gloomier Eurozone outlook compared to other major economies. Despite this, Q3 growth surprised on the upside, with a preliminary reading of 0.4% quarter-on-quarter likely to be confirmed on Thursday. This will be accompanied by quarterly employment growth and September industrial production figures. Germany's ZW Economic Sentiment Survey on Tuesday might draw some attention, but the collapse of the coalition government and looming snap elections are of greater interest. These political developments could lead to a reform of Germany's debt brake rule, which limits new borrowing to 0.35% of GDP. The yen's losses deepened post-US elections as the dollar soared to a 3-month high of 154.71 yens. The primary cause for the yen's decline is the uncertainty surrounding the Bank of Japan's next rate hike, with a 40% probability assigned to a 25 basis point rise in December. However, the BOJ might wait until after next year's spring wage negotiations to decide. To shift expectations towards an earlier rate hike, there needs to be a notable improvement in growth and inflation data. Better than expected Q3 GDP figures on Friday could provide a temporary boost to the yen. This week has been marked by a flurry of economic and political developments worldwide. From the market surge following Trump's return to the White House to the UK's evolving fiscal policies and the euro struggles amid political uncertainty, the global economic scene remains volatile. Meanwhile, in Japan, the yen's weakness continues, with the potential for GDP data to provide short-term support. As markets react to these factors, staying informed on upcoming economic releases will be crucial in understanding the potential shifts in central bank policies and their implications for global markets. To conclude, as we navigate through this week's trading landscape, it's essential to closely monitor these significant updates. We appreciate your confidence in our insights and wish you prosperous trading in the days ahead.